What's going on, everybody, and welcome to another episode of the Investors Digest Market Report, brought to you by PRYME Homes, and I'm John Barr. And this is also being played over our podcast on the Investor's Journey. And if you don't know what that is and you're hearing for the first time, definitely check out wherever you get your pods, Investor's Journey. It's something where we go over our business daily, not daily, but give out tips and tricks of how we run our business. There's usually a podcast or two every week, so definitely go out and check that out. But we will go ahead and get started on this and move right into it. So this is the numbers through January and February. It takes quite a while for some of the places where I compile this data to come out. It doesn't usually come out till right towards the end of the month to get the information that I really want to see. And a lot of it's from SABOR and other government agencies. And I mean, you can tell the unemployment is still far behind, still kind of feeling some of those delayed effects of the government shutdown we had right there in December and January. So the average sales price here in San Antonio climbed 1.55% over this time last year. Anytime you see YOY, that means year over year. Climbed up to $259,753. The median sales price exploded right into 2019 with a 6% increase year over year to $209,900. Total sales up $2,200, which is a 9.3% increase year over year. Average rental price jumped 3.1% from this time last year to $1,446. So those are all good numbers heading into 2019 that were really kind of coming in strong with appreciation as far as total sales, sales volume, sales increases, rental prices. That's really good outlook for the start of 2019. The employment increased 2.31%. We gained 8,100 jobs from last month. And employment jumped to 1.158 million. Unemployment did increase. This is the only thing that was kind of concerning. But if you're looking at this on YouTube, or you can look at the slides, you can see that a 0.46% increase from the previous month isn't that big of a deal, considering we are still below the national average and the Texas average we're sitting at 3.64%. Now, if I see that 0.5% increase month over month, I would start to voice some concern in looking to see what is causing those increases like that. So the month inventory did drop almost a month. Now remember, a month's inventory is where we gauge, as investors, the heat of the market between buyer and seller. And they say a balanced market is 6 months of inventory, and we're sitting at 4.53. So anytime we're lower than that 1 month, that means we are in a stronger seller's market, that there's more buyers than there are sellers, and that's bringing months of inventory down. And when that does go down, the lower that number gets, the more demand housing is, and the more chance for appreciation, because that means houses are selling quicker, and the public is consuming all the inventory, so appraisers are trying to find the equilibrium price, and they will increase prices from there. So now you can see the median sales price plotted since June 2010 and that till now and this is actually through February 2019, and you can see right as the bottom that we hit in 2011 the way we have increased. Now, if this is your first time tuning in, what we're looking at is these are the real estate cycles that we have. They are seasonal. So what you're seeing, when it swings up, that's the summertime. When it swings down, that's the wintertime. People don't move around or buy as much when it's cold out. They don't want to be moving across the country or moving their kids around, loading up trucks when there's potential for ice if they're loading up coming from out of state, or it's cold and windy down here in the wintertime. So the summertime when school's out is when we see those biggest price appreciations. And that holds true even when things are swinging down. The prices tend to move up a little bit, as you can see down here in 2010 and 11. And now you always will get a little bit of a spike right there in December, and what that is trying to get everybody to get into those houses before the new year rolls around. So a lot of times in December, you'll see a lot of contracts in November, a lot of pendings, and closes in December, which usually kind of drives prices up a little bit. So you can kind of see our rebound that we hit the bottom down in January and we took back off, just like we have in the past couple of years, where we get to the bottom in January, February, and we start moving right on up. And I would expect that to continue the way this year is starting, to potentially head setting new highs that we hit last year of $225,000 for a median sales price. Monthly rents, as I said, they did climb, and they followed an exact same cycle. So if you're a landlord, I do this with my personal home. I try to rent houses in April and set 12-month leases. And if I'm renting into January, I try to set like a 15-month lease because I want them ending right around that March, April time frame to where if I need to get in, do a rehab, I can do it, clean it up, get it ready, get it back on the market, and catch this next appreciation ride. Now, it does rise a lot slower than sales price, but we still do have cycles from the bottom of the year to the top of the year, and it's the exact same thing. January is the worst time to be trying to rent a property. You got to lower rents to try to get somebody in there. And then when you get to the summertime, when kids are out, people are moving around, same reasons as with sales prices, you can get higher rents for your properties. So now for the unemployment, and this is why I am not too worried about a 0.5% increase, because you can see how long we've been down here and how low we actually are to historically looking back a year or two ago, we were sitting above 4%, and now we're down to 3.5%. But why I am looking at that is, like I mentioned, if I see 0.5%, 1% increases month over month, like we did in the financial crisis and over here in the dot-com bubble, that's when I'm going to start sounding alarms saying something's going on in the economy, that people are getting laid off. And if people are getting laid off, that means they don't have jobs to where they can't go and buy houses at that point, and credit can potentially be contracting, making it harder for homes to sell. So keep tuning in and listen to this. So if I start sounding the alarm, seeing that kind of rising, I'd expect to see them roll over into some real estate prices. Now, the year-over-year appreciation, the reason I'm tracking this is to kind of get a gauge on the market of like how hot it is, and is it going to continue to appreciate or move a little slower. And you can see it coming out of the last recession. I mean, we were hitting 10% for almost 3-4 years, and even higher than that. But the long-term trend since that time of 2011 hitting the bottom, we have seen to slow down a little bit. We're seeing a little bit lower lows, a little bit higher highs than we were during that time over here coming out of the recession and through kind of 2014 and halfway through 15. But we have jumped up, and like we said, this month we were sitting at 6% appreciation, and the total appreciation from the data that I have is a 5.2 average. So we still are above the long-term average, and the 12-month average is still higher as well. So it seems things are still appreciating very nicely here in the San Antonio MSA. Now, the favorite part of the market reports is kind of where to market. Where do you, as a real estate investor, wholesaler, flipper, home buyer, or doing the BRRRR strategy, whatever it is that you're doing, where do you market that you would get that best appreciation? Where's the most in-demand housing? Where do you market to try to find that property that you can buy, hold on to, that has that good fundamental that prices are going to continue to go up? While real estate is more of a cash flow play, you do have that appreciation that everybody does want, because you can create a great amount of wealth off of appreciation. So I do it two ways. I do it first by price range, and then I do it by zip code. So here in San Antonio, you can see where people are living. Now, you can kind of see, or keep that in mind, that 6 month is that balanced market between buyer and seller. And you start to really hit that 250 to 300,000 price point, and once you hit over 400, you start getting more into a buyer's market, especially the higher you get. And that's that home affordability in San Antonio that everybody talks about, that San Antonio is historically an affordable housing market. But you can see where the most in-demand housing still is in San Antonio, and since we were historically the affordable housing market, is this 100 to 200 price point. And you look at when we're like towards coming out of the slowest time of the year, and only 2.3 months of inventory in that 150 to 200 price point, that's your entry-level basic need housing point at right now in this market. And builders cannot build houses that cheap for a 3-bedroom, 2-bath, 1,500 square feet with a 2-car garage and a backyard. I have seen some driving around here in San Antonio that are starting at the 140s, but you have no garage. It's a 3-bedroom, 2-bath, like 1,000 square foot, extremely basic house. And that's what builders have to do to get down into that price point to try to feed this demand for this inventory. So if you're buying and can get houses in that price, in those price points, chances are, if economics holds true, the prices are going to continue to rise until something happens in the economy that makes people get fearful and those prices start to fall. But I don't see building costs dropping that much to where builders can go back in, buy land, and renovate or build houses and really kind of furnish this demand that is driving down here. Now, the next part is by zip code. I do it by the best and the worst zip codes. So you can kind of really see where the best zip code, and that is 78251. That's sitting at 2 months of inventory. And the crazy thing is that it is still sitting at that mid 223 average price. And you can kind of see where it was 2 years ago. So in 2 years, it's gone from basically 295,000 up to almost 225,000. That's 30,000 appreciation in just 2 years on the average median sales price. So there's a lot of demand, and this zip code 233, 247, 239, 250. These are very common reoccurrences that I'm seeing on these market reports, for the fact that these are on the north side of the city. There's a lot of development going on in those areas. So buying in these areas, and it's no surprise that a lot of these are in that sub $200,000 market. Only very few are below that. And then you have 78249 is at the 285, and you can really see how much appreciation has happened in just 2 years. Been a lot of demand over in that area. So now for the worst zip codes, and it's not to say that these are bad zip codes and I would never invest $1 in there. That's not true. It's not what I'm saying. But what I am saying is keep this in mind when you are doing renovations and what you are doing in that area and what your competition level is. Because you see these price points on these things, they're in that $300,000, $400,000, $700,000 price point. A few outliers, and I'll get into that here in a minute of what I think is going on there. But these are expensive homes, and you need bigger margins on there because, while yes, you can get higher prices for that, as you can see, get a bigger margin potentially, you need to make sure you maintain those margins, because if you're holding on to that property for 4, 5, 6, 8, 9, 12, 14 months, that's hard money. Interest payments are due like clockwork every single month. So that means that is coming straight out of your bottom line every single month. So you keep that in mind, in the sense that, what do you ask yourself, what do I need to do to make my house the one that doesn't sit on the average like that? Spend it in doing extra staging, better pictures, doing more renovations of the kitchens and bathrooms, those high return areas of your houses. Put some more money in there to where if you have to spend an extra $10,000 in your renovation, but it saves you 4 months sitting on the open market, interest on a $400,000 house for 4 months is more than 10 grand. So keep that in mind when you're doing this kind of stuff. And my theory is of these lower price points of the 78201, 78207, 202, and 204. So now you kind of ask yourself, why are those on here? And the reason those are on here as the worst zip codes is because these are downtown areas, and downtown San Antonio is going through a heavy gentrification right now. So these areas have traditionally been cash sales. Nobody wanted to represent a seller for 20 grand to try to sell a house over there. So there are a lot of homeowner to homeowner kind of stuff, because they're very run down properties. They couldn't qualify for any financing. But now what is happening is these things are becoming worth that 78207, especially like 2 years ago, it was 55,000. Now it is 70,000 higher on the median sales price. But we have a lot of inventory. So what it is, I think, is a lot of people that's own property over there. It's now becoming worth realtors to represent somebody, get it on the MLS, and somebody to go in there and do the heavy renovation lifts that people need to do to these houses, because it costs what it costs to fix a house. But if the house is only worth 100,000 and it needs 80,000 in rehab, it doesn't work. You can't get it for free or less than free. Somebody could technically pay you for it, I guess, but I highly doubt that. So that's what I think is going on here, is now values are rising in the downtown area, and it is beneficial for them to put them on the open market. And now why you're seeing zero here is I don't put anything on my market report for as far as tracking months inventory unless it has at least 30 active solds or 30 active properties on the market. And in February 2017, 204 had no properties for sale. So nothing sold 2 years ago, but now these things are starting to appear. So something to keep in mind as you are doing your investing. So now that's really kind of wraps it up. Go ahead if you're on YouTube and you want to get this in your inbox every month, head over to PRYMEHomes.com and you'll get a PDF copy as well as this goes out. You can email me with any questions or comments at john@PRYMEHomes.com. And like I mentioned at the beginning, hop over to wherever you get your podcasts and check out the Investor Journey. That's where my partner and I kind of go over go over what we do for our business, tips and tricks in the business of what we see here and what we've learned along our journey becoming investors. And hop on social media and give us a shout. We're on Facebook and Instagram both. Otherwise, we will happy investing, and we will see you guys next month.